Welcome to The Business That Pays with Adam Tolliver from Artisan Financial Strategies, where we mind the business that pays you. In this podcast, we empower successful families and business owners to make informed decisions about their finances through courageous conversations. Through his expertise as a practicing investment advisor representative with Eagle Strategies, LLC, a registered investment advisor, Adam teaches you how to create a wealth ecosystem by combining a practical technical framework with your personal, family, and community values. Join us for this journey where Adam normalizes sustainable wealth building and gives you the keys to make courageous, proactive financial decisions.
It's your money, but making it work for you may be more difficult than you think. A well-thought-out financial philosophy can help, and Adam Tolliver of Artisan Financial Strategies is here to share his. It's great to have you back again listening to Adam's podcast, The Business That Pays. I'm Patrice Sikora, and Adam is very clear on his philosophy, which consists of 4 pillars. All right, Adam, let's take it from the top then. Tell us about pillar number 1.
Yes, Patrice, thank you so much. Pillar number 1 is understanding your money relative to time. This is really important because throughout your life, you're going to have sort of these key milestones that are relatively fixed based on your age, based on your retirement, based on your family profile. And a big thing, just from a basic standpoint, when we're making decisions about where are we going to put our money, understanding your money relative to time is a big part of that.
Right.
One of the first questions that we ask is, when are you going to need this money? And so if you make a decision that this is money that I'm going to need within the next 6 to 12 months, that gives us some idea about where we can or cannot save or invest that money, how much risk you should be taking or be willing to take based on money that you need comes from understanding it relative to time. And so that's the first big one, huge.
So how do you get people to sit down and determine how long they have to save and invest before they're going to need this money?
Sure. So when we're going through the financial planning process and we're in the clarify phase, so remembering our process is assess, clarify, and then track.
Mm-hmm.
In clarify, we're getting really clear on what the goals and objectives are. Some goals are going to be short-term by nature. We may know, we're dealing with a young family and we'd like to buy our first house or our second home, wherever we're at. We want to buy a house within the next 18 to 24 months. So the next 1.5 to 2 years. Realistically, we feel like we'll be at a place where we can buy a house. So, that may be something that has an automatic timestamp on it. Another thing may be, I enjoy my corporate job. It's been good to me, but I kind of want to branch out and do something on my own. So I have a 10-year plan. And within 10 years, I know that I want to be in a place where I can leave and launch and branch out and go on my own. And so in the clarify phase, we're getting very clear on some tangible goals if they exist. Sometimes that's not necessary. So we're thinking more along the terms of the generic, those timestamps that I was mentioning just before. Retirement, like knowing that standard retirement age is 67. So that's something that's already fixed on your financial timeline. And we actually do provide that for clients. When we go through the planning process, we take your age, the age of your partner, the age of your children. We put everything on a timeline so we can mark, this is when our children are college age. And where does that exist on your timeline? This is where spouse number 1 turns 59 and a half. And what are the triggers for that? What does that mean financially about decisions you make around your retirement planning? This is where spouse number 2 turns 59 and a half, 67, 72, and so on, all of these key ages.
Mm-hmm.
And we make decisions about what to do with your money based on that. Where are we actually going to put it? And what type of risk can we afford to take?
And that's another key word there, risk. Not what you can take, but what your client might be willing to accept.
Absolutely. And reorienting to get people to understand everyone has their own risk tolerance for sure. But when we talk about time, it's important to understand that the closer the time horizon, the sooner we're going to need something. Logically, we want more stability the closer we are to that time.
Right.
So if I need something in the next 6 to 12 months, the next 18 to 24 months, it's not going to be invested or allocated nearly the same way as, say, my retirement plan, which is 25, 30, 35 years down the road.
And that allocation is important too, as you were just saying. It's a type of savings or investment vehicles that, well, sometimes you just say they're not going to work and you just immediately eliminate them.
Absolutely. And having this as a main pillar in philosophy allows you to rule out, we've talked about this before, Patrice, but a lot of what people are facing, especially in the early going with making financial decisions, is this information overload. There's so many different thoughts and opinions and ideas about what exists and where it's smart to put your money and where it's not. But if you are thinking in terms of time, you can start to eliminate things right away. If I know that it's a long-term vehicle and I'm not going to touch this money for a long time, I don't need it for a long time, well, ideally, you should be looking at something that's going to get you some return, because you don't want to lose money to inflation. And because you're not going to be touching it, it's all the more reason for it to be doing work for you.
Is it difficult to convince someone that maybe the investment they're thinking of might not be the best vehicle for them?
It can be, and it really depends on the client. Oftentimes, it's just a matter of talking them through the pros and cons of an individual investment choice. Someone may have their own opinions and past experiences based on their own directly, or maybe a family member or something, why I'm never putting my money in a CD. I'm never putting my money in this. I'm never putting my money in that. But this goes back to sort of the core process that we take clients through in education, so that in that process, we're getting connected and grounded to common ideas, common terminology, and common decision-making factors. How are we going from A to Z before we make a recommendation? And of course, that dialogue is always ongoing, because ultimately it is the client's plan. And so we want everyone to be confident about the direction that we're going in. But as long as we have that open communication and the clarity around why we're doing what we're doing, it typically works out.
All right. Pillar number 2.
Yes. Pillar number 2, understanding your money relative to function. And this is ultimately about, what does your money actually do for you? So I am from a school of thought that essentially believes that money only serves one of 3 purposes. Regardless of where you put it, your money is serving one of 3 primary purposes.
Okay.
First purpose is that it is liquid. It's accessible. You can reach in and grab it. The amount that you see is the amount that you have. You don't have to worry about any type of penalty for touching it early. You don't have to worry about waking up one morning and it being a lot less than it is unless you spent it. And so that's where most people are familiar with, like your savings account, money at the bank, even your checking account where you normally spend your money. The second purpose that it can serve is protection. So this is going to be things like insurance, money that you use to protect your income, your health, your property, and your family. And then the third purpose is for growth and wealth accumulation. So money that you put with the goal of beating inflation and of building long-term wealth. And so understanding the function of your money is really important. The first question that we asked was, when am I going to need this money? The second question that we ask is, what is this money going to do for me between now and when I need it?
Is it mutually exclusive that a dollar can only do one thing, like be liquid, or can it be functional in another way and also get you, well, can we cover more than one base with a dollar here?
Yes. And ultimately, that is the aspiration of good financial planning. We want to create efficiency by taking dollars that you work for and giving them multiple jobs. So it's great for your money to be accessible, but for every gimme, there's a gotcha. So it's wonderful to have accessible money, your liquid money. If something goes sideways day to day, you know that you've got that immediate security for emergencies, for paying the bills. But the price that you pay for that is, again, your money's not growing for you in most cases, especially in this environment. We've got low interest rates. So the bank has not paid you a lot of money for keeping a large balance there for a while, and they likely will not be for a while. So at some point, we've got to figure out where else can we put our dollars that are going to serve other purposes and get more useful value out of a dollar than just being accessible. And that is ultimately the goal, what we're trying to figure out when we make allocation and investment decisions from a financial plan.
Adam, can you give me some examples of that?
Sure. So if we're looking at money from a protection standpoint, when we are making recommendations, you may have different types of insurance products or different types of investment products. If we are going with a mutual fund that's meant to be midterm and not earmarked for retirement, so it's a non-qualified brokerage account where you're growing your money, ultimately that money's primary purpose is to grow and increase your wealth over time while beating inflation. But what it can also be is the backup emergency fund. So it is relatively liquid, right? But it's not the primary function. Whereas liquid is your savings account, your liquid money there is pretty one-dimensional. The primary purpose of it is to be where you need it to be. Your investment account is going to do that plus some. And ideally, you start to use that savings account or your emergency fund as the buffer to protect you from disrupting the growth that you get in your investment account. When we look at the insurance side, we may be looking at, for those who have the right cash flow from a plan, doing a hybrid insurance type of solution where you can also get some sort of savings or growth benefit in addition to protecting your family. And so when we look at that, we see those as efficient dollars in your financial plan because you're taking $1 to serve multiple functions as opposed to just putting it in savings where it serves one function.
Got it. All right, we're moving on here. Pillar number 3.
Yes, pillar number 3 is about protecting your downside. So we just talked about the importance of protection. A big part of this, when we think about risk management and planning, the idea is that throughout your life, there are certain things that could happen and then certain things that are going to happen that if they are not planned for can be financially catastrophic. So an example like that would be if you've got a 2-income household, one of those breadwinners in the home becoming disabled and not being able to work, or someone passing away too soon, or a car accident that keeps you out of work for a while. These are things that are obviously terrible and we hope that they don't happen, but they need to be accounted for in a plan because they are reasonable risk. Mm-hmm. And so that's a huge part of what we do because the idea, of course, is to make sure that if and when these things do not happen, you're not left to try to figure out how to replace an income source or have to pay for a large expense out of pocket.
And how would you do this?
So risk management is a core pillar in any comprehensive financial plan. Just by going through and assessing where you currently are, we're identifying those gaps to figure out, based on your benefits package at work, based on what you may have accumulated over time outside of work, do you have enough protection for you and your family? Is your home, your property and casualty insurance, your car, is all of that in order? Do you have enough? Are you paying too much? Same thing with your life insurance, your disability insurance, your long-term care insurance. The idea is that we want to, what is the reasonable probability of a catastrophic event occurring? And then based on the means of the individual client, so how much cash flow is available, can we prioritize taking care of it, or is it a risk that we're willing to take for now based on other needs?
And then maybe meet it later on?
Absolutely. And so we've referenced this in the process episode, but when we make recommendations, we are always trying to triage and prioritize to figure out, okay, what is most urgent based on your lifestyle, based on your family, based on your income, what do we address right now? And then the other things we want to make sure that we put at least a loose timestamp on to say, okay, we couldn't address this time around, but within the next 18 to 24 months, or whatever the relevant timeline is, this is something that we'll need to be mindful of.
Got it. All right. And then we're up to pillar number 4 already. So much information. But number 4, you say, is get in and stay in. Tell me about that.
Yes. So pillar number 4 is about getting into the market and staying in the market long term. There are tons and tons of investment philosophies. And I always say that if the goal is to take your money and put it away and grow it for the long term, you're going to run into a lot of different ideas that are pretty decent ideas or pretty good ideas and may work. But ultimately, I think in order to get consistent results, you have to focus on your time in the market more so than you do trying to time the market. So trying to jump in and jump out at different times. The earlier that you get in and start to participate in growing your money in investments, the better off you're going to be, especially if you have a long-term track of mind and are not going to fall into the trap of jumping and flinching every time the market goes up and down, because that volatility is something that we are going to understand will happen over the long arc of time.
So a long-term, disciplined approach to putting money into the market.
Absolutely. And all of that really falls back into the previous 3 pillars, because again, the questions that we're asking, when am I going to need this money? That's going to inform us how much risk we can take. What function is this money going to serve for us? So what does this money do for me between now and when I need it? So if I know that I don't need this money, take, for instance, your retirement account. If you know you don't need it until you're going to be 65, you don't need to be flinching when the market has a hiccup and you're 33, because you have plenty of time for the market to correct itself, which historically it has always done, regardless of how catastrophic things may look. And so that's a big part of it. It is understanding the mindset for how to approach it, knowing that you want to be consistent, you want to stay in, and you want to enjoy it. And quite frankly, what the data shows us is that people who are overactive in trading in their accounts tend to have the lowest returns, because their emotions are making them outthink the room and make decisions that they don't need to make, ultimately losing them money.
Right. The market has been extremely volatile, let's say the last year or so. Well, since March, definitely. Have you found yourself holding hands a lot with your clients?
Honestly, not so much. And what I attribute that to is our process and our philosophy. It all goes back to setting reasonable expectations, arming our clients with the right mindset when it comes to their investments. And ultimately, we are human beings and we're all susceptible to some of the same biases. Behavioral finance is something we will talk about a lot on this podcast in the future. Good. But the way that we behave is not always logical. It's not always rational. So what we do within our plan and within our philosophy is we build in the systems that protect us from our base inclinations when it comes to how we want to handle our money. Because a lot of it is just defensive and reactionary. So we want to build out a plan that takes into account the common follies that investors tend to fall into that end up sabotaging them in the long run.
Well, you put this all together, and it is a financial philosophy, Adam. Now, how can people reach you if they want to talk to you more about this?
Absolutely. So you guys can reach me at Tolliver at artisanfsonline.com, and I'll be happy to hear from you.
And Tolliver is spelled Tolliver, correct?
That is correct.
You got it. All right, to be alerted to new episodes of Adam's podcast, The Business That Pays, subscribe to the subscribe button on this page. And of course, you can also share with the share button. I'm Patrice Sikora, and let's talk again later.
Thank you for listening to Business That Pays. Click the subscribe button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of the Artisan Financial Strategies or Eagle Strategies LLC, a registered investment advisor. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial professional provider with any questions you may have regarding your investment strategies.
Adam Tolliver, registered representative, offering securities through New York Life Securities, LLC, member FINRA SIPC, a licensed insurance agency. 1125 Cambridge Square, Suite C, Alpharetta, Georgia, 30009, 404-219-9311. Financial advisor offering investment advisory services through Eagle Strategies, LLC, a registered investment advisor. New York Life Securities, LLC, and Eagle Strategies, LLC are New York Life companies. Artisan Financial Strategies, LLC is not owned or operated by New York Life Securities, LLC, or its affiliates. Neither Artisan Financial Strategies, LLC, nor its advisors provide tax, legal, or accounting advice.